Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, July 31st, 2023. It is 12:41 p.m. as I'm starting the video. So midday update, I'm going to do in the following order. A quick update on the equity markets. Reiterate that Apple and Amazon report this week. That's Thursday after the market closes, followed by the jobs data on Friday morning. So those are, to me, probably the three biggest events for the market this week. And so, of course, those come at the end of the week. My guess is a lot of floundering around between then. The market's been more conducive, at least in that. Well, most of the indexes, that is, have been conducive to active trading versus swing buy and hold trading. We're kind of leveling out in the last month or so here in the Nasdaq 100. I had to use this chart where I just replicated the lines. This is the September contracts of NQ Nasdaq 100 futures. There's the primary trend line, which we remain above, and we have a nice support level right here as well, and that would be the first decent or half decent or more sell signal we get in the market if we can take out the trend line. And then we had these what I call post FOMC, post Fed, and the rest of the big tech stocks that reported last week. Those couple whipsaws through there, and that established this support level there about 15,510. So it's a lot cleaner board. The other futures, the continuous contract that I was using before, right now has a wonky candle right here, and that flattened everything out. So this is what we were looking at. So that's why I had to replicate it and get off the continuous contract to the regular September contract. It's just a technicality with this platform, but it is the same line. And of course, I had additional levels on that previous chart. As soon as they fix that candle, I'll go back to using that other chart on the continuous contract. So that's that. And let's just look at the big FANG stocks, and we'll get to wheat, crude oil, natural gas. I left that one out. Somebody mentioned that in the last video. So go to the triple Qs, and you can see this is what we're looking at here. We have the divergences continuing to build. This is, QQQ sort of, again, just in the last couple of weeks or last month or so here, flattening out in this little range right here is, again, both the technical posture of the market leaders has been bearish despite the current trend. We've had some sell signals on some, still waiting on sell signals and earnings reports on others. And you guys know the level I'm watching, which is pretty much last week's lows. That should do the trick to get us going to the downside and have these divergences play out. And when you look at the leaders, Apple's going to be really one of the last big techs to report, along with Amazon, Thursday, August the 3rd, after the market closes. So right here on this line, and you can see, as I've mentioned, we're below the primary trend line. There was our red breakdown candle, but we're kind of drifting higher with the divergence still very much in place. In fact, you can see the momentum indicators. The divergence is steepening now, and that's because when you're going up on a pretty strong advance, and then you start to slow down, that's where your momentum rolls, and that's what happens, and that typically indicates a trend change when you have divergence, big divergence that's been building for a while. So that's that, and my outlook on Apple hasn't changed. I still think post earnings we go down, and I think we go down to at least that 176.15. But again, we're not going to know until at least Friday, because they report after the close on Thursday, and then Friday's a weekend, the last trading day, I should say, before a weekend. So, by next week, we should have a good idea whether the market and these key stocks can power on through these divergences, ultimately take them out, head on to new highs for the S&P and the Nasdaq, or if they're going to fall short. Microsoft already reported, still well below its earnings reporting date. Or earnings reporting previous high, I should say. Alphabet popped after earnings, still has that big divergent high. This is the fourth trading day, down today, but nothing much. We'd need to really enter that gap right there to help confirm these divergences right now. We have big potential, I call them potential negative divergences, because the PPO is still pointing up. I need to see that PPO make a bearish crossover, thereby, and I need to see it happen at a lower level than the previous high to do what I call confirm that divergence. And so if we do roll over soon and start to get into the gap and they want to backfill the gap, that should do the trick and confirm this as being a big divergent high. Amazon also reporting on the 8th, so take anything, including this pre-earnings breakdown with a grain of salt right there. I'm talking about this uptrend line right here off the early March lows, and we just have to wait till they report. Same technical posture as mostly the big fangs. Big negative divergence that's been building for a while and indicates to me more than just a pullback or correction. You know, dip buyers, I'll do what I always do. I'll give you levels to buy. There's a really good one right there, 126.37. So if you're a glass half full gal or guy, that's your pullback. If you happen to get that post earnings, that'd be a drop from where we're at today. Let's just say the stock drops down to that level. We'll call it 126 and change. It's about a 5.5% drop. That's where dip buyers and those who believe that this stock is going to new highs, that's where you might want to step in and buy. Likewise, if you're a glass half empty guy or gal right now, thinking these stocks are going to drop in the coming weeks to months, then you wait for a break of that to either initiate or add to a short. Simple TA or trading 101, either buy a pullback to support or wait for support to break, and that's a pretty good level. I'll color that up so we remember to talk about it in the coming days to weeks here. All right, so NVIDIA, they don't report for a while, so we're just going to have to watch really the rest of the semis to see where they take NVIDIA. Tesla already reported well down below its post-earnings close right there, or pre-earnings close, which was right on the primary downtrend line, so still well below. Meta popped, but back testing the primary uptrend line from below, and this one I'm still betting that's going to be a breakdown, back test, and move lower. The only other one I'll mention is Intel. I told you that one reported last week, INTC, and told you it had a very similar setup to Tesla, where it had rallied into a comparable primary downtrend line that was well defined, 1, 2, 3, now 4 reactions, hit that level and hit it with negative divergence. And so I mentioned that as an objective short on Friday, was it Friday? The rally into that, because they reported Thursday after the close, so they popped in that on Friday. If you shorted the trend, nothing much, but you're up a couple percentage points. And again, thing is, you just want to keep a stop somewhat above, because if it pops that trend line, that's going to be bullish unless that pop or breakout fails. And like I say, a breakout is bullish unless it does fail. So that's where you could have a stop. And, if they clip you and we go back down, you could always add back in. I told you I don't have a preference to be short Intel. I think there's a lot more meat on the bone for many other semis and tech stocks than Intel. But with that being said, if you took it, I just wanted to give you an update there and show you how they did step in and sell so far the initial rally into that downtrend line. Wanted to show you something interesting. I've been covering, and as I often do, especially in times of extreme market moves, I look at market internals, both on a downside drop. You want to see in a bear market or a strong correction, you want to see improvement in internals as a potential cue that the market's going to reverse. And likewise, you want to see deterioration in internals. What I'm seeing, what I've pointed out for a while, as many others have, is throughout the first part of this big leg up since the beginning of the year in the big market leading tech stocks, you saw it was mainly, in statistics show they attributed to about the top 6 or 7 stocks posting the vast majority or accountable for the vast majority of the returns in the NASDAQ 100 due to not only their heavy top weighting, but also their stark outperformance compared to the other 90-something stocks in the NASDAQ 100. And then as of recently, as I said, these guys were getting toppy, and you'd find more meat on the bone or better risk-reward ratio on the bottom tier, the rest of the stocks. That's what's been moving up, and that can be easily evidenced or, checked out by looking at QQQE, the equal weighted NASDAQ 100. here's what I wanted to show you. So we have seen that kind of tick up in internals. In other words, participation by the other 90-something stocks in there. And again, that's evidenced by the outperformance or relative outperformance of the NASDAQ 100. But what I see that's kind of sort of unusual, it is unusual to me, and it's a potential buying climax. Let me just turn up my volume here. Here's my volume bars so you can see these real clear. Okay, so down on the bottom, I'll turn off everything else, all the other trend lines. This is unusual. I've been watching QQQQE for many years. It is, again, the equal weighted NASDAQ 100 ETF, so it gives you a equal weight, 1% each roughly for all 100 stocks in there. And so it is, in one sense, healthy that we've seen that uptick. What's unusual to me is the amount of volume in this one. Again, over the years, I've never seen such volume. And the outperformance of the top big tech stocks, again, has been unprecedented. Since you can go back in history, since the NASDAQ's been in existence, and I read statistics that there's never been such stark divergence. So it's a very acknowledged trade. And it didn't take, in my opinion, a lot of foresight to say, hey, now underweight the big tech and overweight the rest of them in for a hedge trade, a game of catch up, or just a pure play on one handful of stocks being overvalued and some being undervalued. So best case scenario, if the market holds up, you're going to see better performance there. Okay, so again, I don't think it was an incredibly difficult trade to figure out. And so what I can see is many have done that. However, here's my analysis. This is my take. They did it via an ETF. You can see a huge, unprecedented surge in the volume here. Let me up my volume bars here, and you can see. So this shows you a little bit clearer. We've seen a few blips, one-day big sells or buys come into that equal-weighted ETF, but we've never seen anything like this. Now, what this tells me, plain and simple, my analysis, right or wrong, is that institutional and or individual investors, instead of the normal, healthy, broad participation you want to see in a rally where those stocks are being bought up based on their own fundamental outlook, based on investors' outlook for those individual companies. People were playing the technicals. They were playing that outperformance card, and they were simply throwing money into this ETF, the equal-weighted NASDAQ 100, which in turn will, of course, boost those stocks because they, instead of every dollar that goes into the QQQ, guess what? The top 6 companies get over 50 cents of that dollar goes into those top 6. The other 49 cents or so is divided among the remaining 94 companies in there. And so they hardly move the needle. But in this case, they all get that boost. So my theory here is this is this buying of this ETF to take advantage of that gap has pushed those companies up more so because this ETF is seeing tremendous, unprecedented inflows, and not necessarily that their fundamentals are improving. Now, maybe they are. And again, I shared there were quite a few much better charts, in my opinion, to go long on a lot of those, technically speaking. But take it for what it's worth. I just wanted to point that out. And that also could be a potential buying climax. A buying climax is when something's been rising for a long time. You have an extended uptrend getting long in the tooth, and then all of a sudden you see a big surge in volume. And that is, again, what the term is called a buying climax. You get that final rush. Everyone has that FOMO, fear of missing out trade. Money comes in, and these type of buying or selling climaxes, if it occurs at the end of a prolonged downtrend, especially on a sudden swoon down, then that's called a selling climax, and that's a way to identify potential bottoms in a stock or an index. Oh, okay, and just to be clear, here's QQQ. You do not see anything even remotely close to a comparable surge. What you can see in QQQ over time, you can see near-term buying climaxes right there. That's a buying climax, and that was followed by a selling climax. That was followed by an 11% rally. You can see a few there. When you see these big bars, there was a pretty decent near-term selling climax. That was followed by a sharp bounce, and then another one. So you can see that's where sellers were capitulating right there, and that eventually marked a bottom. There was a selling climax, a beautiful one right there to be bought. And again, you don't see anything similar here on that surge like you do on QQQE. So I just wanted to point that out. And then I took a look at SPY as well, of course, in the equal weighted. You can see really no big surge in SPY. The only thing you see right here, a little selling climax at that point, at that drop off there. But when you look at RSP, that's the equal weighted ETF for SPY, you see the same thing. So not as a large to a large extent as QQQE, but a considerable increase in volume. In fact, the biggest volume we've ever seen in this ETF, just like QQQE. So again, right or wrong, that's a working theory I have, that it's been a very well announced and talked about trade, and I think we've seen the buying come in again via ETF buying, not so much natural buying per those individual stocks, which would to me would be a better sign that maybe smart money institutions are finding longer term value in those and starting to position into those. So ETFs are more of a hot money trade. They're a trader's vehicle, in and out. Okay, just jump over. One trade idea. I've been combing through stocks as I always do, looking for trade ideas. I know I've had a disproportionate number of short trades lately, and I'll do my best to get long trades out there. A few weeks back, I was putting quite a few. We were looking at the bottom tier, the stocks in the NASDAQ and other indexes that hadn't participated, and a lot of those really popped. But I told you I was personally cooling off on that dash for trash trade, I call it. But MRNA, it's bearish in the fact that this stock is flirting with 52-week and even multi-year lows when the stock market is trying to not too far from new highs. So that tells you, hey, any stock that's at a 52-week low when a lot of stocks are at or approaching 52-week highs, something's wrong there fundamentally. But then again, we've seen this whole dash or trash, and this is what, as of lately, until that trend is completely over with, that's where the opportunities may lie. What I can tell you definitively is this is good support, 116, give or take, about 116.32. You can go back all the way here. Let me change my tool to a little circle tool here. So you can see Moderna had support. This time it had positive, aka bullish divergence. You got a nice rally off it, hit that level again, actually had even bigger divergence. I didn't mark that, but there it is. And had an even bigger rally, right? And now we've come full circle. We're back to that level. So there's a downtrend line in which to trigger a long entry. Or if you are of the bearish persuasion, particularly in this stock right here, is a break of that level there. Solid break below 116.30 or 116. If you want to be safe, give it a little bit of room. That would most likely send the stock lower, and you wouldn't want to allow for a recovery, because if you get a little pop, that could be a little stop clearing raid or a short, what do they call it, a bear trap. And so then you'd have a stop. You'd want to stop anyways, if you're going to short, that is, above this trend line and a little bit above there to give it some room. I just wanted to share the trade idea again for those looking for long trades, because you can go long here with either a very tight stop or give it, again, a little bit of room to allow for a potential last minute shakeout move below that level. All right, targets, I haven't even listed them. You can see there's obviously a nice level there at that previous reaction high at 212. I would certainly say right here, I'm going to give you two that I can see right now. This would be the first two levels, about 143 and then 162.50 if you are interested in that. One that I'm going to pass on for now, but I'll continue to update. And if you have any questions on this or any other stocks, let me know. PAYX, I was watching that one as well. I think this one is an objective short entry. I'm also watching this sector very closely. This falls under the staffing and outsourcing sector. So you have companies like ADP, think payroll, employment firms, things like that. And you can see this one has, first of all, resistance, really nice resistance here. If I turn up the volume at price histogram, you can see a lot of trades have occurred up to this level right here. You see the big red and green bars right there. So you have that, and that tends to act as resistance. Plus, I had it there first and foremost, that line, because I see price resistance. In fact, to be honest with you, I didn't even notice the volume at price histogram until I started this video right now. But I have a lot of reactions around that level to validate it as resistance. Big, strong run. This, to me, reeks of a short squeeze, kind of FOMO trade. And typically, runs that happen like that are followed by almost an equal move down. So I think there's a lot of potential here on this one. I think it's an objective trade, a nice RR. You can put a short just above the recent highs. We've already overshot that level, had a momentum fueled overshoot, so you don't need to give it much more room. You can have a pretty tight stop right around, even maybe a hair below that previous high right there from last week. That is the Thursday's high of 129.70. And then if you look down here, you might notice I have these blue lines. I don't know if you can see them. These are what I call high-level bearish PPO crossovers. So we have one not yet taking place, but very, very close. The PPO is curled down. A crossover, bearish crossover, looks imminent and likely. Again, it has not happened yet. I put the line there just to kind of show you that it's coinciding with that run into resistance. There was our last high-level bearish PPO crossover. You first had a little what looked like an imminent cross. You had one last bounce, and then boom, the crossover came right where I put the line. And so if you look at these, what I call, again, high level, because high level means well above the zero line. You don't want to pay attention to those down here. So there, those are the last three I marked. And you can see what happened to the stock on those bearish PPO crossovers. They all, within days, week or so, resulted in major turns in the stock. So there's a trade idea for you, actionable at this point in time. And then I'm keeping an eye on the sector as a whole, because employment's everything. Fed is hyper-focused on employment. I'm really, heightened in watching the employment data, jobs numbers, and these guys might give us a little clues. ADP put in a divergent high here, and this is a stock that peaked, went on to break that trend line. I just modified a little bit, put in a divergent low there, so pop. It has an almost identical pattern. Also, if you look at ADP from the RSI down here, here's your oversold line right here at 70. Let's just circle the last few times this stock was, I'm sorry, not oversold, overbought. Excuse me, be corrected there. Overbought right there with divergence. And that's what happened after that. Overbought right there. You get the point. So a lot of things pointing at potential shorts here in the employment stocks. So there's a lot of others. I won't go through them all now. That wasn't the point of this video. Every now and then I'll deep dive into a sector and go over my top picks or all the components there. But I just want to point out, these are the two biggest, by the way. ADP is $104 billion company. PAYX is second largest in the sector at $46 billion. So they're going to kind of give you a good clue as to where the sector is going. And if these guys are rolling over, it's typically not a good sign for the jobs market, which is everything right now, in my opinion. Probably the biggest thing to watch, other than what I'm about to get into. And that is the whole inflation trade and interest rates and everything. You got everything that I see and read. I'm seeing articles, good time to buy bonds, rates have peaked, they're only going to go down. I mentioned last week, big levels here in the 10 and 30-year bonds, especially the 10-year you want to keep a close eye on. This thing, again, is in spitting distance of these multi-year highs. If it pops that level, we're still above trend, takes out those highs, this thing could run, especially if these divergences are taken out. When you look at a longer-term chart, a weekly chart, let me park this histogram, get it out of the way here. This would take, we're already right now, we're at about 4% yield on the 10-year, and that takes us all the way back to where we were right here. This is right before the financial crisis started, or right when that bear market started in late 2007. And it really takes us back into right before the dot-com bubble there. That's late 1998. So you can see where we're at. And from a both a technical perspective, and there's your primary uptrend line. I've made the case over and over again that this appears by just about every metric. I believe we're in a new secular bull market for interest rates. And I'm talking, this isn't a micro and intermediate, this is a long-term call. The last secular trend in rates went down. We peaked back in 1980s, late 1980, early 1981, and we've been in a downtrend since, which I believe that officially ended when COVID hit. And again, it's going to take a long time to play out, and there's many ways it can. We can come all the way back test the primary trend line, or we may not, for at least not for now. We may continue on up this steep uptrend line. That would be, bottom line, it would be very, very bearish for the market. So I recently talked about coming across a few articles, and with the articles, they were making the case, the bullish case, or at least the case why up to this point the economy hasn't buckled under the weight of these big interest rate increases. And the articles I cited, and maybe the data was spun a little bit, was stating that in recent years a vast majority of debt was taken out at fixed rates from corporations as well as individuals, and not variable rates, and therefore people and institutions have locked into 2.5%, 3.5% interest rates. And they're not, those loans aren't coming due yet. They're not feeling the pain, right? It doesn't matter to you, me, my 2.5% mortgage. If I decide to hold on to this house and that mortgage, I have it for, another couple decades plus. And that's never going to change. So I won't be impacted by rising rates unless I were to go out and buy another house or another car and decide to do so on credit. However, I found this article and I found it interesting. This was dated again. It was dated last fall, August 16th of 2022. It's from the, you might not be able to see it up top, the Federal Reserve Bank of St. Louis. And you have the number of loans to U.S. businesses by type. Bottom line is there were in recent years a lot more variable rate loans put out. And the numbers are huge. There's 80,000 versus 20,000 at that benchmark back in 2013. Now we went up here, but you can see, and again, this article, maybe I'll put a link below in the video, shows that even though what the other articles I was reading were trying to support a bullish case, the total amount of variable rate loans has come down in recent years with those ultra low rates, but there was an uptick, and it is still, the differential is still much higher than fixed rate loans, and has been in recent years. And this is the value of those loans on the books, value of loans to U.S. businesses by type. Variable rate loans, you can see, and they were upticking again. To this article was published last fall. There was that sharp drop off there, but you didn't have a huge increase, a concurrent increase in fixed rate loans. But at bottom line, you can see the differential. It's about 3 to 1 or more in recent years of variable loans. Where am I going? Well, these rising rates, mark my words, or everything in modern economics and finance, it just doesn't hold true anymore. And just always buy every dip of every market. No, this will play out, and these loans will come due. And these variable rate loans, the individuals or corporations, businesses will have to finance and refinance, or have their rates adjusted upward. So the bottom line is there's a lag time. When you take out a variable rate loan, every loan is different depending on how the structure of the loan, how long a term it is, as to how often the rates reset and to what benchmark they reset at, whether it's LIBOR or any other variable rate, constant maturity Treasury. They have different benchmarks. But I wanted to just point that out there. And then, do this on your own. If you do like fundamentals, look at the fundamentals. And again, when I talk about fundamentals, it's long-term. Everything, that chart I just showed you and these charts have nothing to do with market timing, when to get short, when to get long. They do paint the bigger picture and the long-term outlook to help at least me formulate, just how bad might the next recession be once it finally is clearly underway, or how mild it might be. And you can, I'll go to this site. I use this one all the time, tradingeconomics.com. and click down here on consumer, and you have all these. I would encourage you to go through all these, or as many of these as possible, like retail sales month over month, used car prices. There's some great charts in here. This one is credit card balances. And you can see, and these are more real time. These are updated. I go back usually. You can click 10 years, you can click max, whatever you want on the time frame. But you can see a surge, and credit card rates are going through the roof. They have gone up in line with interest rates. I don't know. I think the average rate I heard is like 25% now. And the U.S. consumer is a lot more indebted. Even remember when COVID hit, every credit card balances went down because the government was throwing money out to everybody, individuals, whether you worked or not. You got a check. If you ran your own business, you had a windfall with the PPP or payroll protection plan, and so consumers paid down a lot of debt. They were flush. They weren't spending. They weren't traveling. So that money was going in their pocket. They weren't eating out, and so we've all had that. We've seen that resurgence trade where people started flying and traveling again and eating out and all that. But I think that's run full circle. You can tell I did the video the other day on the restaurant stocks. Throughout Chipotle as a short, and followed up with McDonald's today as an official short trade. And so we'll continue to focus on that sector. I just wanted to, point this out. And when you go down the line, you can see, auto loans, click these charts, take a look at, go back a few years, and you can see the surge in all this consumer debt. And things like auto loans, those aren't like a mortgage. Those aren't like 30-year mortgages. They're not locked in that long. You're going to see, people have been holding on to their cars longer and longer, especially with the high car prices lately. But down the line, you're going to see just huge debt, consumer debt and corporate debt swelling. And again, the takeaway is that debt, especially the part of it that is our adjustable rates or fixed rate, like a car loan, but shorter term in nature, these rising rates are going to have an impact. And my fear is it could be a flashpoint, especially. Again, it all ties into what I started out with, the 10-year Treasury. You can look at 5-year Treasuries, 30-year. If those rates go up, I believe there's going to start to be I think the markets are going to be much more hypersensitive now for any more upside, because we're already pushing that upper end of the the range as far as rates go. Remember, we're back to where we were earlier or late last year, so the market's able to tolerate this. It's not like they got used to it here, they got used to it here. But again, as time goes on, even if this stays constant, even if rates don't go up, again, you're going to see massive amount of debt in the coming years, starting with this year. I thought I heard there's like 1 trillion of variable corporate debt coming due, if I'm not mistaken. You're going to see those loans rolling over, many of which were taken out here at these rates, here. And again, we haven't seen rates like this. I'm going back on this chart. This goes all the way back to 2018. You have to zoom out all the way here. We have not seen rates this high since the last Great Recession, right? All the way back here, 2008, 2009, and beyond that. So again, I think there's going to be an increased sensitivity to rising rates with each tick above where we are now. And it goes the other way, guys. Net, that should be bullish if rates go down. Now, I threw out a caveat before. Should be isn't guaranteed or always, because what could bring rates down would be a very sharp drop or a trend, a clear reversal in trend in the stock market with stock prices falling, and or the economic data rolling over, because then the market's going to price in or increasingly price in those Fed rate cuts and deflation. So that's certainly a possibility that would not necessarily be bullish for the stock market. And I'm sorry, my goal is not to come across here as the whole heads I win, tails you lose kind of scenario for the bullish case, because this falling interest rates with the economy holding up and the job market holding up and the stock market holding up, that would be a net positive. So again, you just have to watch. There's so many variables in this stuff. It's not black and white. And again, that's why I talk 40 minutes in these videos. because these things are not straightforward. All right, let's wrap the video up, keep it kind of short with a quick update on commodities. Wheat, I got out to you this morning, told you before, and the updates on wheat, when we were back here a couple weeks ago, I said I liked that, the breakout, then the back test, then we started to move impulsively higher. But I said we had to take out this point, and when we did, the only problem that I saw at the time, and it started to play out already, is that negative divergence, and it's led to a pullback. I'd said, consider buying down to, but not much below T1. When I say a little below, give it a little bit of room. I think it's still an objective entry. I mean, if I zoom in really close, we're a hair below that level. We were higher this morning, and we continued a little lower. So if you bought, I'd still maintain it's a buy, and give it a little bit more room. Not much, not too much. It's up to you, depending on where you think things are going. And we can always re-enter, and maybe we'll come down here and form an uptrend line and keep the uptrend intact. We're still well above that low and still well above that low. We need to reverse, and this is one spot. I had you here this morning, and now we're even a much, much better support level. And so it's another objective long entry if that's your thing. And, we'll watch that whole commodities trade. But what I'm really watching, the commodity which by far, without even a close second, has the biggest impact on inflation, of course, is crude oil. For everything from the cars you and I drive to the heating oil you heat your house with in the winter, the same stuff power plants are running on, or airplanes are flying on, all this stuff being derived from crude oil. And you have the breakout now, not much. Remember, I've been highlighting this level right here. Pretty big support, about 72.30, really since going back almost a year now, well, at least to December. And we're above it. Still have, by the skin of our teeth, negative divergence. If we can start to power through here, remember I said in the last update, I believe it was, I said it's not an all or none kind of binary or long and bullish. It's more of an incremental thing. If we can continue to push through here, just like interest rates, I think from this point, each tick higher with oil, we've had a big run lately, and that's going to be reflected in the July CPI numbers when those come out. That's it. Today is July 31st. Come hell or high water, there's nothing that's out there that can undo what's happened. And look at the timing of it. Like I said before, I've been following that whole inflation thing for a while, where I go to DJP, excuse me. There's DJP, and I go to the boxes little months in, and I said a lot of times we've had some upticks. This one we started to run early in the month, but by the end of the month we fell. And so when you take an average, you were right about where you started. Here you were lower. So most of the months we finished lower. Last month we averaged higher, at least on this broad-based commodity. This one's not even close. There's if the July numbers come out and they show any type of downtick or even a flat line on energy prices or core PCE, which is the big one with food and energy, because as I heard Powell say himself out of his mouth on the press conference, they watch core PCE very closely. He says very often it's dismissed. They give you the core with X minus food and energy, because food and energy are very volatile. But at the end of the day, what the Fed said is it is food and energy that ultimately lead to core inflation throughout everything else. So and energy is a big one. So we'll watch that. And again, it's not just the fact that we've had a strong surge in crude oil and commodities as a whole, as DJP has shown us here, but we're also at a point where crude, if I can get back to where I was, is poised for potential breakout above that resistance level here. Like I showed you, the level that's been capping all advances in crude since going back all the way to November here, right there. So something I'm certainly watching, and if it goes the other way, sellers step in. This is, and again, one day is not going to make a difference, 1 week, but if we do this in the month of August, guess what? Then it just reversed all those increases right there, and this would be a net bullish for the equity market. Net bullish doesn't necessarily mean bullish. I sometimes have to explain my words because I got to at least comment. Net bullish just means that one component would be a net bullish factor. There could be 10 other things that might be bearish going on with the stock market at that point in time. So that could overall bring the market down. But it's hard to argue that falling energy prices are not bullish for the economy. Okay, and as promised, natural gas, left it out in the other video, but I did post a chart for somebody who had asked. I responded to the Friday's video, and I gave this chart here. So, we're still, here's a story on UNG. It still appears to me like it is trying to pound out a bottom. You have this basing pattern here. We hit my first target, hit my second target, and that's pretty big resistance. And as I've been saying for a while, we need to now take that out, and that's about $8 in UNG. And that would be a breakout and most likely send us up to the next target and then probably beyond that, because more so would have taken us out above this basing pattern. It's not over yet. We could go the other way. Don't have super strong convictions at this moment when I look at even the 60-minute charts, but there is a potential uptrend line that if we break that could be would be bearish, would be certainly if it breaks, and it has the potential to either give us another leg down, possibly even go to new lows. I don't think there's not a lot more downside. Remember, UNG is a commodity; it doesn't go to zero. Neither does corn, wheat, or soybeans. And we're already at the not just the 50 coming off the 52-week low, but we're at a multi-year low, and we are still, although inflation has abated, we're still in an inflationary environment. Year-over-year numbers are still hot. Most other things are a lot well off their multi-year lows. Most other commodities. So therefore, this one is likely. I think at worst case scenario, may grind around in this range for a little while longer. But if it does break out, again, this is like energy building like a coiled spring. If it breaks out, it could really run, and I'll continue to update it. Again, I just don't have very, very strong convictions near term. I'm looking at the 60-minute charts. It's just kind of this sloppy range, and there's not really any clear, well-defined trend lines or big divergences or anything that tell me which way it's going to go in the next few days or weeks. Gold and silver, told you I was bullish on that last week. Near term, just you can let it run, raising stops, or if you want to take profits, we're coming up to a little bit, maybe a little bit of a minor downtrend line plus price resistance there on gold. Silver, silver's up another 2% today. So just since hit this divergent low the other day, it's about 3% in the last few days. And of course, GDX is going to run with it. GDX also recently putting in that almost divergence here on the PPO. But right now, near term, lately I've been giving you my thoughts on near term direction for active trading as well as intermediate term. They're not super high. You can either just let it run with stops in place, or take profits if you stepped in and bought it at the last divergent low and when gold hit support the other day. It's been a 4% pop in the last few days in GDX. Up to you. All right, let me wrap it up here. Get the video out to you guys, and again, we'll watch Amazon. It's going to be a while, and until then, I think the market will probably be, as it has been for the last couple weeks, more conducive to very active trading off the short-term charts. Look for these little divergent lows, divergent highs, trend line breaks. This is a 5-minute chart of QQQ. That was our most recent divergent high right here. And so this would indicate to me some downside. Let's duplicate that, DH, put it up there, and probably swing it down here would be my guess over the next couple days here. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great